Welcome to the deep dive. Okay, let's get right into it.
Yeah, let's do it.
Today we're looking at a company that honestly sounds like it's straight out of science fiction. Recursion Pharmaceuticals, ticker RXRX.
Right. I mean, millions of automated experiments a week, petabytes of data.
It's wild. And the goal is basically to use AI, robots, all this tech to try and industrialize drug discovery, which, is famously messy and risky.
And you, our listener, you brought us the sources for this one. Stock reports, financials, market data, company filings, the works.
Exactly. And our job today is to sift through all that, specifically looking at it through a value investing lens.
Sort of a Warren Buffett approach, maybe, applied to this super high-tech clinical stage biotech. Can it even work?
That's the question, isn't it? We want to pull out the key insights for you, help you understand Recursion's business, their financials, what management's up to, market sentiment, the risks, which are pretty big, and why this kind of company is, well, a real puzzle for traditional value investors.
Before we really dig in, though, just a quick mention of our sponsor, Stock Analytics AI.
Right.
If you like these deep dives, check out their YouTube channel. They do more analyses like this, often based on listener requests.
And if you're a member, it's Euro $4.99 a month. You can actually give them a ticker, and they'll prioritize doing a deep dive on it for you. Pretty neat.
Yeah, good resource. Okay, so Recursion. As we go through this, you're going to notice this fundamental tension, right?
Definitely. Applying these classic value principles, think solid earnings, predictable cash flow, to a company built entirely on, let's be honest, speculative future potential.
It creates this clash. Well, what is that core conflict? Let's try and unpack that today.
Chapter 1, Understanding the Business. Their mission statement is decoding biology to radically improve lives. Lofty goal.
Very. And the problem they're targeting is huge, that roughly 90% failure rate in traditional drug development, the sources mention. It's incredibly inefficient.
So their solution is this recursion operating system, the OS.
Yeah, it's this mix of wet lab stuff, those 2.2 million automated experiments every single week, basically seeing how cells react to drugs or gene changes on a massive scale.
And dry lab computation. So AI, machine learning, crunching all the data from those experiments.
And it all feeds this enormous proprietary data set, over 65 petabytes. It's hard to even picture how much data that is. Phenomics, transcriptomics, real-world data.
Millions and millions of HD movies worth, apparently. And they've built the hardware for it. BioHive, too.
Right, their supercomputer, claimed to be the most powerful in biopharma, top 100 globally, built with NVIDIA.
And they're also developing something called LOWE, an LLM agent.
Yeah, a large language model, basically an AI assistant to help researchers streamline workloads. It's all about scale and automation.
Okay, so they make some big claims about efficiency based on this system.
They do. The sources say they claim to cut timelines by about 50%, research costs down 35–40%, and maybe boost the probability of success by 27%.
Sounds impressive. But, and this is big for value investors, right? The sources are clear. These are internal metrics.
Exactly. They haven't been validated yet by drugs actually succeeding in trials and hitting the market. So it's promising potential, not proven value generation, not yet anyway.
Which leads us straight to their revenue, or lack thereof from products.
Correct. Zero product revenue. All their income, according to the financials we looked at, comes from these collaboration agreements with big pharma companies.
And some of those deals are pretty substantial. Bayer, for instance, oncology, fibrotic diseases, potential for over $100 million per program in milestones and royalties.
Then there's Roche and Genentech. That was a big one back in early 2022. $150 million upfront for neuroscience and oncology programs, potential for over $1 billion in milestones down the line.
And they just got a $30 million milestone payment from that in August 2024, which is good news for cash flow.
Definitely. And the Sanofi deal, partly from the Exscientia acquisition, right? They got a $7 million milestone in Q1 2025, with potentially hundreds of millions more possible. Merck KZA is another partner mentioned, contributing revenue.
So these deals are crucial. They bring in cash without selling more stock, which is good.
But the reports also flag the downside. Heavy reliance on just a few big partners. If one pulls out or priorities change,
their revenue stream gets unpredictable. And unpredictability is something value investors generally don't love. They prefer stable, recurring income.
Right. Now, looking broader, the AI in drug discovery market itself, it's definitely growing fast.
Yeah, the sources throw out some big compound annual growth rate numbers, anywhere from 10% to nearly 38%. Market size projections hitting maybe $16 billion plus in the next decade.
It's driven by that need to cut costs and speed things up in drug development. Personalized medicine is another driver.
Still a small slice of the overall drug discovery pie, which is huge, and the even bigger biotech market, but it's clearly where a lot of innovation is happening.
Key trends mentioned are things like combining AI with big data genomics, proteomics, generative AI for designing molecules, drug repurposing, and, like we see with Recursion, tons of strategic partnerships.
The regulatory side is interesting too. The FDA is trying to keep up, putting out draft guidance on AI use, setting up councils.
But it's complex. The sources highlight challenges. Data quality is a big one, the risk of underestimating costs, the black box issue with AI decisions, potential bias, just making it all work reliably at scale.
So that adds a layer of regulatory uncertainty, especially for companies like Recursion, where AI is absolutely central.
Absolutely. And getting into the space isn't easy. Barriers to entry are high. You need massive capital for the tech, you need the data, you need the talent AI experts and biologists.
Recursion's existing setup, the data, the supercomputer, that's potentially an advantage against newcomers.
For sure. But it comes with those really high running costs we talked about.
Which brings us to the idea of a competitive moat, that durable advantage. What do the sources say?
Pretty bluntly, Morningstar says no economic moat. And Veladia's Benjamin Graham score is just okay, 57%.
So again, the tech is potential, maybe future moat, but it's not proven to be a defensible advantage right now. Not until it consistently produces results.
That lack of a clear moat today is a big red flag for a value assessment. Now, the Exscientia merger in late 2024, that was a major strategic bet.
Yeah, an all-stock deal, around $650–700 million. The idea was to combine Recursion's biology platform with Exscientia's AI chemistry expertise, create an end-to-end system.
They're hoping for big cost savings, over $100 million a year in synergies, and expecting it to stretch their cash runway out into 2027.
But mergers are always risky, aren't they? Integration challenges. And it's interesting that those pipeline cuts happen relatively soon after in May 2025.
Right. They cut 3 clinical programs, paused another. Management says it's about focusing on the best shots on goal.
Which makes sense strategically. But from a value perspective, doing it right after acquiring a bigger pipeline, well, it could suggest maybe the initial assessment wasn't quite right, or integration is proving tricky, forcing rapid adjustments.
It raises questions, and the competition isn't standing still. Sources list Schrödinger, Benevolent AI, Relay, InSilico, Atomwise. Lots of players.
And they have different models, right? Like Schrödinger gets revenue from software licensing too, not just collaborations like Recursion.
Exactly. So it's a race. Everyone's trying to prove their platform works by getting drugs successfully through trials and approved. That's the ultimate validation.
Okay, let's talk about management. Chapter 2. Who's running the ship and how are they doing? For a value investor, this is critical.
We've got CEO Chris Gibson, a co-founder, CFO Ben Taylor, Chief R&D Najat Khan, and David Hallett, the CSO who came over from Exscientia. Some recent board additions, too, bringing in specific expertise.
One point the sources raise, or that a value investor might raise, is CEO Gibson's external roles. BioHive, that altitude lab incubator.
Yeah, while promoting the local biotech scene is good, a hard-nosed value investor might question external commitments when the core business is burning so much cash and needs intense focus. Just a potential perception issue.
Analyst takes on recent decisions, like those pipeline cuts, seem pretty mixed based on the reports.
Yeah, one analyst, Manny Forhar at Leerink, was quite critical, called the cuts inevitable due to unsustainable cash burn. Ouch.
She's also apparently found the phase 2 data for one of their drugs, REC4881 for FAP, hard to interpret. That's not great feedback on clinical execution or communication.
But other analysts quoted see the strategic rationale, right? Focusing resources post-merger to extend the runway. It shows they're making tough calls, but maybe reacting rather than proactively planning perfectly, given the timing.
Let's zero in on capital allocation. How are they spending money? Because they're spending a lot of it.
Oh yeah, R&D spending is the big one. It's huge and climbing. Q1 2025 R&D was $130 million. That's almost double the $68 million from Q1 2024.
Wow. And full year 2024 was over $300 million.
And this is driven by integrating Exscientia, plus deals like the Tempus Data agreement that had a $27 million non-cash expense hit in Q1 25.
So that R&D is what's driving the losses and the cash burn, essentially.
Pretty much. And the pipeline strategy itself, those May 2025 cuts, That's a major capital allocation decision. They're stopping spending on those deprioritized programs to focus elsewhere.
Management says they're focusing on programs with stronger science, higher potential.
Which sounds logical, but again, the timing post-merger and that hard-to-interpret data point, it adds a layer of uncertainty about how well the overall strategy is playing out.
They've also used M&A quite a bit. Exscientia was the massive one, but also Cyclica, Valence, VM before that.
Right. Significant capital deployed to acquire capabilities. Whether those acquisitions ultimately accelerate drug discovery and create value, well, the jury's still out. It takes years to see.
And shareholder returns? None, really. No dividends, no buybacks, which is typical for this stage.
Their funding comes from selling equity, the IPO, private placements, those ATM sales where they trickle shares into the market.
They netted about $84 million from a $300 million ATM program recently, plus public offerings, and the collaboration payments, of course.
But that heavy reliance on equity financing means dilution for existing shareholders. Each share becomes a smaller piece of the pie over time.
Governance seems standard, according to the sources. Anti-bribery policies, code of conduct, whistleblower protection, majority independent board.
Yeah, the framework looks fine on paper. Consistent application is what matters, though.
So, summing up management. Making big moves, adapting to challenges. But the high burn, the losses, the long road ahead. Value creation is completely unproven at this point. Capital allocation is necessary, but it's high risk with a very long payoff horizon.
Exactly. Okay, let's get into the nitty-gritty financial health. Chapter 3.
Yeah, the numbers. The sources clearly frame Recursion as a high-investment pre-profit company. No surprises there.
Looking at the income statement, revenue is solely from collaborations, as we said. It grew from about $10 million in 2021 to nearly $59 million in 2024.
Q1 2025 revenue was $15 million, up a bit year over year, but the reports noted it missed analyst consensus of around $18–20 million.
Seems it was due to timing of milestones, like that $7 million from Sanofi hitting in Q1. Shows the lumpiness of that revenue stream.
Gross profit is volatile, too. Q1 25 gross margin was actually negative 48%. Costs exceeded revenue for those deals in that period.
Yeah, though the full year 2024 margin was positive 23%. It can swing wildly.
Operating expenses are the main story. R&D, we covered $130 million in Q1 25. SG&A, the general admin costs, also jumped significantly to $55 million from $31 million the year before.
Mostly driven by Exscientia integration in those data deals.
And the bottom line, consistent large losses. Q1 2025 net loss was negative $203 million. That's way up from negative $91 million in Q1 2024.
Full year 2024 net loss was negative $463 million. Trailing 12-month earnings per share is negative $1.82.
The Q1 25 loss per share, negative 50 cents, technically beat estimates slightly, but it was still a much bigger loss than the year before. The trend is definitely escalating losses due to these investments.
Now, the balance sheet. How are they funding this? Cash is king here.
End of Q1 2025, they had $509 million in cash, equivalents, and restricted cash. That's down from $603 million at the end of 2024, so burning through cash.
Total assets ballooned after the Exscientia deal goodwill. Intangibles up to $1.31 billion in Q1 25, from around $650 million pre-merger. Liabilities were about $371 million. Equity around $974 million.
Debt seems manageable relative to cash, maybe $25 million in interest-bearing debt according to some sources.
And short-term liquidity looks okay based on the ratios. Current ratio over 4, quick ratio near that. They can cover immediate bills.
But the cash flow statement, that's where a value investor really focuses.
And it's consistently negative from operations. Q1 2025 operating cash flow was $132 million outflow, worse than the $159 million outflow a year ago. Full year 2024, $359 million burn from operations.
That Q1 number included about $16 million in one-off transaction costs, but still it's a huge operational burn.
Investing cash flow is also negative buying assets, acquisitions. Financing cash flow is positive. Historically, that's the money coming in from selling stock.
Which brings us to free cash flow. Operating cash flow minus capital expenditures, often seen as the true measure of cash generation.
And for Recursion, it's deeply negative. Q1 2025 free cash flow was an outflow of almost $134 million. FY24 was negative $373 million.
One source mentioned an alpha spread DCF model projecting negative FCF for years, resulting in a negative intrinsic value. That's a massive red flag for value investors. They're just not generating cash.
Management gave a Q1 operational cash burn figure around $118 million, excluding inflows and one-offs. Their target for all of 2025 is $450 million or less burn, excluding inflows. That's down from the combined 2024 burn of around $600 million.
Hitting that $450 million target is absolutely critical for their survival, isn't it?
It directly impacts their runway. That $509 million cash gives them a runway into mid-2027 if they hit those burn targets.
But that's a big if. And the source of stress, this projection relies on meeting targets and doesn't account for needing even more cash or potential positive surprises from collaborations.
The reality is, given the losses, they'll almost certainly need more money selling more stock or landing some huge unexpected milestone payments well before mid-2027. That constant need for capital is a key risk.
Okay, moving into the second half, let's gauge market sentiment. Chapter 4. How does the market feel about RXRX?
Analyst ratings are mixed, generally hold or buy, depending on the firm. Price targets vary a lot. Sources mention a range from about $6.75 up to nearly $13.
Compared to the stock price around $4 recently, those targets suggest analysts see potential upside.
But, and this is important, analysts have been cutting those targets recently. Leerink, Needham, Morgan Stanley all lowered theirs after the Q1 results and the pipeline news.
So the cuts directly reflect those concerns about cash burn and clinical execution we keep coming back to.
Yeah. The overall analyst view seems to be cool tech, big potential, but very cautious right now due to the financials, the early pipeline, and the partner reliance.
What about the options market? Can that tell us anything about expectations?
Sometimes. The aggregate put-call ratios mentioned in the sources are low, around 0.4. That suggests overall more open interest in calls, bets the price will rise, than puts, bets it will fall, kind of a bullish tilt in aggregate.
But you have to look closer, right?
Exactly. For near-term options like May expirations, the sources noted higher put open interest at specific strike prices like $4 or $4.50.
So that could be hedging people protecting their stock or outright bearish bets for the short term.
Could be either, yeah. But then if you look further out, like June options or longer, there's significant call open interest to higher strikes, $5 to $7.
Suggesting speculation on good news later, or a longer-term recovery perhaps.
Seems likely. And implied volatility is high 60th to 77th percentile. The market expects big price swings.
So the options market paints a picture of, well, mixed signals. Cautious optimism overall, maybe, but with near-term hedging and longer-term speculative bets. It definitely reflects anticipation, not value assessment.
Pretty much. Okay, Chapter 5. Ownership. Who holds the stock?
Institutions own a lot.
Yeah.
75, 77%, maybe even higher depending on the source. That's common for biotechs.
Shows professional interest. Top holders include names like ARK, Vanguard, Bailey Gifford, BlackRock, SoftBank, Mubadala, Novo Holdings, big players.
The presence of funds like ARK and SoftBank is telling, though. They're known for growth, high-risk, high-reward plays, not traditional value.
Right. It indicates the shareholder base has a significant component willing to bet on the future potential, accepting the current lack of profits. There's been some buying and selling among them. SoftBank and Novo initiated positions recently.
What about insiders? Management, directors, large affiliated holders?
Reported ownership ranges quite a bit, 3.6% up to maybe 17%. CEO Gibson, Zachary Bogue, Mubadala are mentioned among significant holders.
But what about recent transactions? Buying or selling?
That's where it gets interesting from a value perspective. The sources highlight multiple sales by insiders over the last 6-12 months.
Often cited as for tax purposes or via preset trading plans, right?
Yes. CEO Gibson sold shares in May and March 2025. CFO Taylor, Chief R&D Khan also had sales mentioned. These were planned or tax-related, reportedly.
But the key thing noted in the reports is the lack of recent open market purchases by top executives.
Exactly. While sales for taxes happen, value investors usually like to see management putting their own money on the line, buying shares at market prices if they genuinely believe the stock is undervalued. Stock awards are compensation, not the same signal.
Okay, Chapter 6, Risk Assessment. Let's use that SWOT framework from the sources: strengths, weaknesses, opportunities, threats.
Strengths. The sources point to the AI platform, the huge data set, the supercomputer, those big pharma partnerships, the added capabilities from Exscientia, focus on high-need areas like oncology, and that cash cushion, however, limited the runway.
Weaknesses. Pretty clear. No commercial products, no profits, big and growing losses, high cash burn, early and risky pipeline with recent cuts, integration risks, reliance on collaboration revenue.
Opportunities. The growing AI drug discovery market is a big one. Validating the platform with clinical success would be huge. Expanding into new areas, getting more partnerships, ongoing tech advances.
Threats. Intense competition, the fundamental risk of clinical trial failures, Regulatory hurdles, especially for AI. Financing risk and dilution from needing more cash. Data security, platform reliability.
And there's a specific external threat highlighted in the sources, the 2025 U.S. tariffs.
Right. This seems quite tangible. New tariffs on goods from China, Mexico, Canada, impacting biotech supply chains.
Yeah, the sources detail specific percentages, 20% on some lab stuff from China, 25% on equipment from Mexico, Canada, potentially huge tariffs up to 245% on APIs from China, 25% on other inputs.
This isn't theoretical. It directly hits Recursion's costs for glassware, instruments, reagents, maybe even AI hardware components.
The sources cite industry cost increase estimates in the $10–20 billion range annually. That's significant.
And it's not just cost, it's disruption, right? Finding new suppliers takes time, costs money, could slow down research if there are delays or shortages.
Exactly. Reshoring isn't really an easy option for the specialized inputs they likely need. It could also strain international collaborations.
So the bottom line from the sources on tariffs, likely higher operating costs, especially R&D, could accelerate cash burn, potentially shorten that runway. It's a direct headwind against their goal of using AI to reduce costs.
And we're just reporting what the sources outline here neutrally. It's presented as a real-world challenge they and the industry face.
Okay, Chapter 7, Conclusion. So to wrap this up, sticking to the sources and that value investing lens.
It's a paradox, isn't it? On one hand, you have this incredibly innovative technology, massive scale, big partners, huge market potential. It's exciting stuff.
Definitely. But through the value lens, the sources paint a picture dominated by risk. No product revenue, huge losses, high burn, limited runway, risky early pipeline, intense competition, external pressures like tariffs.
No positive earnings, no free cash flow, no proven moat, according to the analyses cited. Based purely on traditional value metrics found in these sources, it just doesn't fit the mold.
And investment today, based on this deep dive into the sources, looks like a pure bet on the future success of their platform. A bet that's years away from potentially paying off and faces enormous hurdles.
So that core conflict we mentioned at the start, it's this. Applying traditional value analysis to Recursion highlights the immense gap between its current financial reality, high risk, no profits, and its speculative technological promise. The value is almost entirely potential, dependent on years of successful execution in a really tough industry.
Which brings us to that final provocative thought, the hook reveal. For a company like Recursion, built on a high-tech future, do traditional financial metrics even capture the story? Do they paint a fair picture?
Or, as you consider companies like this, do we need entirely new ways to think about value when that value is so deeply tied to a future that hasn't happened yet and might not happen as planned?
It's a really interesting question for investing in this new era of AI and biotech innovation. Something for you to mull over.
A lot to digest there. Thanks for bringing us these sources and letting us dive deep into Recursion.
We really hope this breakdown, looking through that value lens, based only on the provided materials, was useful for you.
And remember to check out the Stock Analytics AI YouTube channel for more deep dives. Subscribe if you find them helpful.
And our standard reminder, this discussion was for educational purposes only, based entirely on the sources provided to us. It is absolutely not investment advice.
Investing in biotech, particularly clinical stage companies like RXRX, is inherently very risky. You could lose your entire investment.